This summer's housing market was a lot hotter than most people expected. Rather than correcting or even crashing like a lot of analysts predicted, housing prices have actually gone up. Whatever way you look at it, housing prices are surprisingly up. And recently, I've been noticing a couple of headwinds that could take some steam out of the housing market. So today, we're going to dive into recent housing market data and do our best to interpret what it all means for the market in the coming months. Before we jump in, no matter what type of market we're in, there are always good deals and good opportunities. And honestly, in correcting markets, good deals actually become more abundant. But it is crucially important, don't get me wrong, you have to be able to differentiate what's a really good opportunity given the market conditions and what's just a risky proposition that you should probably stay away from. This is one of the reasons it's so important to work with an investor-friendly agent. These aren't just any type of agents. They're the type of agent who know how investors think. And they can help you identify great deals, yes, even in this market. So if you want to meet an investor-friendly agent, BiggerPockets has made that very easy. You can get matched completely for free at BiggerPockets.com/agents. There are tons of excellent, proven agents in almost every market across the country, so go check it out at BiggerPockets.com/agents. All right, let's get into this data. Housing prices have stayed up. And if you are curious why this has happened, maybe you're surprised that prices haven't crashed, even though interest rates have gone up so quickly, it all really comes down to supply and demand. The theory about why the market was supposed to go down this year is because higher interest rates would reduce affordability, and that would pull demand out of the market. And that actually has happened. Rising interest rates has brought demand down about 40%. But something else happened at the same time, and that is that supply actually went down even more. I just said that demand was down 40%, but supply is actually down 45%. And if you recall, Econ 101 or anything about supply and demand, you know that when supply and demand both go down relatively proportionately, prices can stay flat. And because supply has gone down a bit more than demand, that actually has pushed up prices, which is what we're seeing over this summer. So when we get to this question about whether the market is going to go up or down over the winter, if it's going to cool off, I think we have to just look at supply and demand and figure out which way these things are going to go. And to me, I just don't see supply moving that much. The lock-in effect, which we've talked about a lot on this show, is real. If you're not familiar with it, it's basically that people who have these all-time low mortgages, maybe they're in the 2s or 3s or 4%, those are historically more low mortgage rates. And people who have them, they don't want to move. And so they're not selling their houses. And there's actually been a bunch of research done into this by John Burns Research and Consulting. And actually Zillow did a similar study and they came up with almost identical answers. So I think that bodes well for this research. It shows that the magic number for mortgage rates to sort of unlock inventory and get out of the lock-in effect is somewhere between 5 and 5.5%. As of this recording, I'm recording this sort of in the first week here of October, we're seeing mortgage rates at 7.7, 7.8%. So we would have a very long way to go, 2.5 points, 250 basis points down to get mortgage points to the point where we might unlock the market a little bit. So I don't think that is going to change anytime in the next couple of months or maybe in the next couple of years, honestly. The second thing that could move supply is foreclosures, but they're actually extremely low. If you look at this chart, you can see mortgage delinquencies by severity, and they're honestly declining. If you look at it for like 90 days, it's like in total delinquencies, it's about flat, but they're not going up. And sure, that could change if there's a big break in the labor market or a deep recession, that could change. But foreclosures just take a while. And so even if this delinquency, which is sort of a precursor towards foreclosures, starts ticking up, I don't think anytime in the next 3 to 6 months, and probably not even in the next year, we're going to see any sort of foreclosure inventory flooding the market and changing the supply and demand dynamics. So to me, supply is just kind of going to stay the same, at least over this winter. And if anything is going to change, it's going to be on the demand side. If we take a look at this chart from the Mortgage Bankers Association, this is basically an index. It tracks how many people apply for purchase applications. So basically, they apply for a mortgage, but not refinances to actually purchase a new home. And they're actually at the lowest point in more than 25 years. And that is considerable. But honestly, I think there are reasonable questions about whether it could actually go even lower. The reason demand is so low is because affordability has gone down. We talked about that at the beginning of the episode. Basically, affordability has deteriorated to the lowest it's been since 1985. because interest rates have gone up so much. If you look at this chart, you can see that's just absolutely nosedived, and it hasn't been this way honestly in generations. There are things that point to this affordability piece actually getting worse. First and foremost, we all know mortgage rates are going up, but they still have some room to run, in my opinion. Just in the last 30 days, from the beginning of September to the beginning of October, rates have gone up from 7.2% all the way up to 7.7%. Even in a year and a half of fast mortgage rates, that's even faster mortgage rates going up. And it is all happening because bond yields are going up. I'm not going to get into many of the reasons, but basically, if you want to summarize it, the economy is looking too hot, and bond traders and most investors are finally accepting that the Fed is probably not going to pivot and start cutting rates anytime soon, and instead, they are keeping rates higher for longer. The Fed has said that for a long time, that that's what they're intending to do, but actually bond markets were betting against that. Now they're finally accepting it, and so we still see an inverted yield curve, which to me means that 10-year yields could keep going up, and we might, over this winter, see mortgage rates averaging above 8%. And I'm saying averaging because some people right now, depending on your credit and the kind of loan you're looking for, could already be getting 8% loans, but the average could actually go up for prime rate to up to 8%. On top of mortgage rates and the affordability, we have these other factors that I think also could put downward pressure on prices in the housing market going into this winter. The first is seasonality. This just happens almost every year. During COVID, it was kind of weird, didn't happen as much, but normally during the fall, prices decline a little bit just because less people are interested in moving and buying a home during the cold months. The second thing is student loan repayments just started. And if you haven't heard, they have been on, hiatus for more than 3 years, but they just restarted. And from research I've done, it shows that the average student loan repayment is going to be about $400 per month. Now, that is really considerable when you think about the fact that affordability is already at the lowest point that it has been since 1985. And then you say $400 per month for a lot of people who are in that prime home buying age, that is also going to reduce affordability. We also have high oil prices. Not everyone pays attention to this, but high oil prices do drag on the economy. That could also drag on the housing market. We have a UAW, the United Auto Workers strike, that is ongoing. And although that, might not directly impact housing, less spending in the economy might lower GDP. This could really change the dynamics of the whole economy. So that is another thing that could drag on everything. And then we also, for now, it looks like we averted a government shutdown, but the parties only agreed on a 45-day extension. So that was like last week or about a week ago. So now 38 days from now, we're going to be looking at potentially another government shutdown. And hopefully that doesn't happen. But if it does, that also drags on the economy. So to me, if you put all of these things together, the potential for lower affordability, the probability that supply is not really going to change that much. We take into account seasonality, student loan repayments, oil prices, the UAW strike, maybe a government shutdown. All these things to me point to a strong possibility that demand shrinks even further. Could supply go down with it? Sure, that is possible, but I think it is more likely that demand falls faster than supply. And now I don't know if that actually means that we're going to see negative year-over-year price growth or just softening because of what happened last year. When you look at prices year over year, there's something that happens called the base effect, where it really matters what happened the previous year. So far, the biggest correction that we saw was in Q4 of 2022. So even if prices start to come down in Q4 of 2023, when we compare them to last year, they might be up even if they are softening significantly. So I think just if you're curious and you want to track this kind of stuff, the thing you want to look at is seasonally adjusted month-over-month data. Redfin has great stuff that you can check out there. Zillow also does too. So that's basically what I see. We're currently right now, at least according to NAR, at 4% year-over-year prices. I would not be surprised to see that decline to maybe 1 or 2% or even go negative over the next couple of months. With affordability as low as it is and all this economic uncertainty, we are going to see a slight pullback in demand, and that obviously puts downward pressure on prices. But I'm very curious what you think is going to happen. Obviously, this is a very uncertain economy, and I am doing my best to read the tea leaves and look at all these different trends, but I'm curious what you think, so let me know in the comments below. For BiggerPockets, I am Dave Meyer, and I'll see you all next week.